Two people invest the same $50,000. 20 years later, one of them is tired, the other is free. And here's the part nobody expects. The numbers, almost identical. So what actually happened? You have $50,000 saved. Not easy money, not lucky money. This is years of restraint. Saying no to trips, to upgrades, to the version of your life that would have been easier, but empty. And now you're here, staring at a decision that sounds simple, but quietly shapes the next 20 years of your life. Do you buy real estate or do you invest in the stock market? Your dad says real estate. Your coworker says index funds. Your favorite podcast says do both. But none of them show you this part, where it actually plays out in real life, over time, with everything included. So let's run it. No shortcuts. No highlight reels, just reality. You're 28. You make $55,000 a year. You live in a normal city. Not flashy, not extreme, just real. You have two choices. Choice one, you take your $50,000 and use it as a 20% down payment
on a $250,000 rental property, 30-year mortgage, 7% interest. Your monthly payment is about $1,330. You find a tenant. They pay $1,800 a month. On paper, you're making $470 a month. You run the numbers once, maybe twice, and you think, this is it. This is how people get rich. Choice two, you take that same $50,000 and put it into a total market index fund. No keys, no tenants, no leverage. You set up $300 a month automatically, and then nothing. No excitement, no conversations, no one cares. One path gives you something you can see. The other gives you something you can ignore. The rent hits your account every month. It feels real. You check it, you rely on it. You tell yourself this is working. Meanwhile, your index fund barely moves. Up a little, down a little, up again. No story, no emotion, just numbers on a screen.
Now you're looking at maybe $2,000, $3,000 over 3 years. And that doesn't include your time or your stress. Meanwhile, your index fund is around $75,000. No calls, no emergencies, no effort, just time doing its job. But real estate has something powerful, leverage. You didn't buy a $50,000 asset. You bought a $250,000 one. And now it's worth more. Your equity grows faster than your cash. And that feeling, that multiplied growth, is what pulls people in. Because the real cost of real estate isn't obvious at first. It shows up later, in pieces. Vacancy, maintenance, big repairs, management, and risk. One bad tenant can erase an entire year. None of this shows up in the simple profit number, but it always shows up eventually. By year 5, you've experienced it. Multiple tenants, unexpected costs, moments where you question the decision. Rent has gone up, but so has everything else. Your real return settles, 3 to 5%, not the number you imagined. Meanwhile, something quiet starts to happen. Your index fund begins to accelerate. Year 5, steady. Year 7, noticeable. Year 10, it's around $170,000. No extra effort, just time. Now both paths are close, closer than you expected. But one demanded your attention, the other only asked for your patience. Year 20, this is where everything becomes clear. Your property is worth around $450,000, maybe $500,000. Your mortgage is nearly gone. Your equity sits right there. After 2 decades, your total profit from cash flow is maybe $50,000 to $70,000. Your index fund, $420,000 to $460,000. Mostly growth, no debt, no tenants, no late night problems. They arrive at almost the same place, but they do not feel the same. Real estate works. It gives you control, leverage, tax advantages.
But it demands something in return. Your time, your energy, your attention. The stock market looks simple, almost forgettable, but it gives you something else, freedom. So the real decision was never real estate versus stocks. It was this. Do you want to build wealth by managing it or by letting it grow without you? Because in the end, you don't get rewarded for choosing the better investment. You get rewarded for choosing the one you can live with for 20 years. And the next time someone tells you one always wins, ask them this: what did it cost you to hold it?